I think that any investment program should have as its foundation a good S&P 500 index fund, okay, which has very, very low fees and is a very smart way to go. That should be your base, and then you build from there for your stock section of your portfolio. I have used mutual funds a couple of times. I still use mutual funds in a couple of areas. When I buy a stock, I don't go through, I don't look at charts and all kinds of stuff like that. That's of no interest to me. Charts tell you anything that you want them to tell you, okay? So what I usually do is I'll look at a company and for instance, if I wanted to buy a company in the automotive industry, okay, I'd find out which company has the largest market share. That would be very important for me. And number two, are their sales going up every year? Okay, that's pretty much the extent of my work when I go to buy a stock. Okay? There are some industries where I can't do that. Okay? If somebody came to me and said, Chamberlin, you can buy one technology stock today, which one do you want? Wow, holy mackerel. Do I buy Qualcomm? Do I buy Apple? Do I buy Microsoft? I don't know. So what do? You buy them all. Okay? You buy a technology index fund. Same thing with healthcare. Somebody said, buy one. What healthcare company would you buy, Chamberlin? I don't know. You buy a hospital company? Do you buy an insurance company? Do you buy an HMO? What do you do? You buy them all. You buy a healthcare index exchange traded fund, something like that. So mutual funds are fine. I've mentioned a couple of people. John Bogle is the father of index investing. He created the first index fund, and Bogle has in all of his years, and he's still out there kicking. I think he's on his fourth or fifth heart right now. I don't know, but he's an ornery fella, as they say. He is the guy that really took on the responsibility of educating people about the two things that sabotage their returns as investors. And it has nothing to do, not a darn thing to do with stock market volatility. He says there's two things that will ruin your return as an investor. One are fees and the other are taxes. You control fees and taxes, you're going to have a popular and successful investment. So that's why index mutual funds have now become the most used mutual funds out there. And the average annual expense on an index mutual fund is below 0.25%. So it's a very, very efficient investment. And that's why I think it should be the foundation of your stock portfolio, and then build on that with some other things as well as you're so inclined. But no, I don't have any problem with mutual funds. Just be aware that today, about 80% of all managed funds, where some manager is there making decisions about buying and selling stuff like that, more than 80% of them fail to outperform the S&P 500. So, it's kind of a no-brainer.